5 months. That is how long this lasted. 5 months of pure, relentless, unforgiving pain. October, red. November, red. December, red. January, red. February, red. 5 consecutive months of losses, the kind of losing streak that breaks people, the kind that makes grown adults sit in front of their screens at 2 in the morning, wondering if they made the biggest financial mistake of their lives. Bitcoin went from $126,000, an all-time high, all the way down to $63,019. A 48% crash, almost cut in half. And when a war broke out in the Middle East, Bitcoin dropped $2,500 in 45 minutes. 45 minutes. And while all of this was happening, while retail investors were panicking, while the comment sections were filled with people saying it was over, while the fear and greed index hit 5, not 10, not 15, 5, the lowest reading in the entire history of that index, lower than FTX, lower than COVID, lower than 2018, something was happening in the shadows that almost nobody saw. And today, March 4th, 2026, the thing that was happening in the shadows just exploded into the open. Bitcoin just crossed $71,680, up 6% in 24 hours. The wall that rejected Bitcoin twice in the last 5 days, the $70,000 wall, broke. And at the exact same moment it broke, the last major Wall Street holdout made a move that changes everything. Stay with me. Because by the end of this video, you are going to understand exactly what happened, exactly why it happened, exactly who knew before you did, and exactly what comes next. Every number in this video is real. Every claim is verified. Let's go. Let me take you back 5 months, because you need to feel this again to understand what today actually means. October 2025. Bitcoin is at $126,000. You remember this moment. The energy was different. Every financial channel was talking about it. Your friends were texting you about it. Your family members who had never once asked about Bitcoin were suddenly asking. The ETF inflows were historic, $118 billion in a single quarter. Morgan Stanley, and hold on to that name because we are coming back to Morgan Stanley in a major way, Morgan Stanley was already telling its wealthiest clients they could touch Bitcoin ETFs. MicroStrategy was buying every single week. Analysts at every major bank were publishing $100,000 price targets. The FOMO was real. The conviction was real. The data supported it, and people bought. They bought at 126,000, at 120, at 115. With full belief, with full conviction, with everything they had read telling them this was the right move. And then October closed red, the first red month of the entire bull run. And people told themselves, normal, healthy pullback. This is what bull markets do. November closed red. They said, extended consolidation. Nothing wrong here. December closed red. The doubt started. January closed red, down double digits. Panic started settling in. And then February. February closed down 17.37%. In 1 month, the 5th straight red month. And by the time Bitcoin touched $63,019 on February 28th, the day the war news hit, the day the market absolutely collapsed, do you know what the fear and greed index said? 5, not 50, not 20. 5 out of 100, the absolute bottom of measurable human fear about Bitcoin, the lowest number that index has ever printed. Not during FTX, when a major exchange went bankrupt and took billions of dollars with it. Not during COVID, when every market on Earth crashed simultaneously. Not during the 2018 crash, when Bitcoin lost 80% of its value. Now, today, this cycle, this correction, 5. And at that exact moment, at the exact moment of maximum fear, at the exact moment when 38% of all altcoins were simultaneously trading at their all-time lows, something happened that almost nobody was watching. Stop. Because this is the part most people completely missed. And this is the part that explains everything about why today looks the way it does. While you were watching the price drop, while the news was telling you Bitcoin was dead, while the comment sections were full of people saying we were going to 40,000, maybe lower, while the fear and greed index was sitting at 5, while retail investors were either panic selling or frozen in disbelief, institutions were buying, not quietly, not secretly, publicly, in documented, verifiable, SEC-reported data. Listen to these numbers carefully. On February 28th, the single worst day of this entire correction, the war crash day, the day Bitcoin hit $63,019, BlackRock accumulated 9,615 Bitcoin, 9,615 coins, at the bottom, $635 million. Deployed on the worst day of the cycle. That is not an accident. That is not a mistake. That is a decision made by people who had information, analysis, and conviction that retail investors simply did not have. It gets more. Abu Dhabi's sovereign wealth funds, the vehicles that manage the oil wealth of one of the richest nations on Earth, added Bitcoin ETF exposure during the peak of extreme fear in February. The government-level money, the generational wealth money, the money that never panics. They added Bitcoin. And then there is Strategy, the company that used to be called MicroStrategy. They made their 101st consecutive weekly Bitcoin purchase during the worst week of the correction. Not their first, not their 20th, their 101st. Week after week after week for 2 straight years, they never missed a single purchase. And during the worst week of this cycle, they bought 3,015 Bitcoin at $67,700 per coin. And today, BlackRock's Bitcoin ETF recorded a single-day net inflow of $322.4 million. 322 million, one day, one ETF. And that is before I tell you the headline that changed everything this morning. Here is where today becomes different from every other day of the last 5 months. 2 things happened this morning at almost exactly the same time. First thing, Bitcoin broke through $70,000. Now you might be thinking, so what? It broke a level. But here is why this level specifically matters. 70,000 rejected Bitcoin twice in the last 5 days. 2 separate attempts, 2 separate rejections. Both times, sellers showed up at that level and pushed price back down. And traders watched those 2 rejections and made a decision, a very expensive decision, that the 3rd attempt would fail too. They bet against it, big, in the derivatives market, with leverage. And when Bitcoin broke through 70,000 this morning and did not stop, those bets got destroyed. $433 million in short positions got liquidated across the market in one move, gone. The bears who had positioned at 70,000, who had watched 2 rejections and doubled down, got wiped out in one of the most painful short squeezes of this entire cycle. $433 million evaporated, forced to buy Bitcoin as their positions closed, which pushed price even higher, which forced more liquidation, which pushed price even higher. A cascade. A mechanical waterfall of forced buying that drove Bitcoin from below 70,000 all the way to $71,680. That was the first thing. Now hold on, because the second thing is bigger, and most channels are not covering it the right way. Wait, before I go any further, if you have been watching this channel for any amount of time, if you sat through October, November, December, January, February watching the price bleed, then you need to hear something directly, because I have been in this space long enough to know exactly what is happening in your head right now. You are watching Bitcoin run. You are watching it break through the level it failed at twice. You are seeing the candles turn green. And there is one of 2 things you are feeling. Either you held through everything and you are watching your portfolio recover and you are relieved but still nervous because you have been burned before. Or you sold somewhere during the 5 months. Maybe at 70,000 when it first broke down. Maybe at 65,000 after the war news. Maybe at some point when it just became too much to watch. And if you sold, watching today happen is one of the worst feelings in investing. You did what felt rational. You managed the risk, and the market recovered without you. I want to acknowledge that honestly. Because the way you react to today determines whether you make money in Bitcoin's next move or whether you repeat the same mistake again. We are going to talk about that. But first, the Morgan Stanley story, because this is the headline that changes the entire landscape. This morning, Morgan Stanley, one of the most powerful financial institutions in the history of American capitalism, filed a prospectus with the United States Securities and Exchange Commission for the Morgan Stanley Bitcoin Trust. Let me tell you what Morgan Stanley is. For the people who might not be fully familiar, Morgan Stanley manages $1.6 trillion in client wealth. That is $1,600 billion. That is the savings, the retirement accounts, the investment portfolios of some of the wealthiest people and institutions in the United States and the world. And until this morning, that $1.6 trillion had essentially 0 Bitcoin exposure. 0. And they just filed for a Bitcoin ETF. On the same day, Bitcoin broke its most important resistance level of the correction. On the same day, $433 million in short positions got destroyed. On the same day, BlackRock recorded $322 million in single-day inflows, all on the same day. You might be thinking, okay, Morgan Stanley filed for Bitcoin. Other companies have done this. What is different here? And the answer is 2 words, BNY Mellon. Because the way Morgan Stanley structured this filing is unlike anything we have seen before in the Bitcoin ETF space. Morgan Stanley chose 2 custodians for the Bitcoin Trust. The first is Coinbase Custody, the institutional custody arm of the largest crypto exchange in America. That is expected. That is standard, but the second custodian, the administrator, transfer agent, and cash custodian, is the Bank of New York Mellon. And if you do not know what BNY Mellon is, let me explain it to you in a way that makes the significance of this filing immediately clear. The Bank of New York Mellon was founded in 1784. 1784. That is before the United States Constitution was even written. This bank has been operating continuously for 242 years. It is the oldest continuously operating bank in America, and today it is also the world's largest custodian bank, meaning it is the bank that other banks, governments, and sovereign wealth funds trust to hold their assets. How large? BNY Mellon currently holds $47 trillion in assets under custody. 47 trillion. To give you a sense of what that number means, the entire Bitcoin market cap at $71,000 is approximately 1.4 trillion. BNY Mellon holds 33 times the entire Bitcoin market cap in assets. For every major pension fund in the world, for central banks, for sovereign wealth funds, for every institutional investor that requires the absolute highest tier of asset safety, regulatory credibility, and operational reliability. When BNY Mellon puts its name on a custody structure, when this bank, with 242 years of history and $47 trillion of responsibility, agrees to be the administrator for a Bitcoin product, it does something that no amount of marketing or lobbying or CEO Twitter posts can do. It tells every single institutional allocator in the world that Bitcoin custody is now operating on the same infrastructure rails as every other serious financial asset. The credibility barrier, the last real barrier between institutional money and Bitcoin, just came down. Now let me give you the math that actually matters, because numbers are how you understand the real stakes here. Morgan Stanley manages $1.6 trillion in client assets. Right now, virtually none of that has Bitcoin exposure. If even 1% of Morgan Stanley's wealth management assets flows into Bitcoin through the Morgan Stanley Bitcoin Trust, 1%, the most conservative possible institutional allocation, that is $16 billion of new Bitcoin demand. $16 billion from 1%, from one firm. For context, the entire weekly Bitcoin ETF inflow for the last 5 days was $1.4 billion. 1% allocation from Morgan Stanley alone equals 11 times that, but it does not stay at 1%. As Morgan Stanley financial advisors, and there are thousands of them, begin recommending Bitcoin as a legitimate portfolio component to their clients, allocations grow. And this is not theoretical. This is the same process that happened with gold ETFs in 2004. The same process that happened with REITs. The same process that happens every time a new asset class gets institutional plumbing built around it. The adoption follows the infrastructure, and the infrastructure just got the most credible endorsement in the history of Bitcoin. And here is the final piece of math that should make you sit up straight. If just the top 5 traditional asset managers, Morgan Stanley, Fidelity, Vanguard, Charles Schwab, Goldman Sachs, each allocate 1% of their combined assets under management into Bitcoin, you are looking at somewhere between $70 and $90 billion of new institutional Bitcoin demand. 70 to 90 billion into an asset with a total supply that can never exceed 21 million coins. You do not need a price target calculator to understand what that does to the price. Stop, right here. I need to explain something about the ETF market that almost no Bitcoin channel is talking about. And this is the reason why $1.4 billion in ETF inflows over the last 5 days produced almost no price movement until today. Here's how it actually works. When a large institutional player, a Goldman Sachs, a Jane Street, a Citadel Society creates new ETF shares, they do not have to buy the underlying Bitcoin at that same moment. They can short the ETF shares first, collect the spread, and then buy the actual Bitcoin in the spot market at a later time when liquidity is favorable. The result is that the ETF reports new inflows, new assets under management, new shares created, but the actual Bitcoin purchases in the spot market are delayed, sometimes by hours, sometimes by days. This is called the authorized participant mechanism. And it is why the 1.4 billion in inflows you were reading about all week looked like it was doing nothing to the price. The authorized participants were building up a massive pipeline of deferred spot purchases, waiting for the right catalyst. And when Morgan Stanley's filing landed this morning, when that was the undeniable macro signal they needed, the deferred spot buying went into the market simultaneously with the $433 million short squeeze. 2 separate demand explosions hitting the order books at the same time. That is why today's candle is the size it is. That is why this move is not just a short squeeze. There was real buying behind it, documented, institutional, and it was being saved up for exactly this moment. Now let me tell you what the data shows about who has been on the right side of this trade for the last 5 months, because this is the part of the story that is going to make you angry. And I think you should be angry because the information was available in public filings, in ETF flow reports, in on-chain data. The institutions were not hiding what they were doing. They were hiding in plain sight. We talked about BlackRock buying $635 million on the worst day of the correction. But let me give you the full picture of what was happening across the board. The cumulative net inflows into US spot Bitcoin ETFs since they launched in January 2024, through every bear move, through every scary headline, through 5 consecutive red months, through the war crash, total $55 billion. $55 billion of institutional money that flowed in and stayed in despite everything that happened. And today, with the Fear and Greed Index still sitting near 10, still near the lowest reading in history, those $55 billion are now sitting on significant gains as Bitcoin crosses 71,000. The institutions did not panic sell at 65,000. They did not liquidate at 63,000. They held. Some of them bought more. And the people who sold during the 5 months of pain, the retail investors, the people who could not psychologically survive a 48% drawdown, handed their coins to the institutions at the lowest possible price. And now those institutions are sitting on the other side of the trade. This is not new. This is not unique to Bitcoin. This is how every major asset class transfers wealth from the impatient to the patient, from the emotional to the systematic, from retail to institutional. The difference with Bitcoin in 2026 is that the institutions are bigger, better funded, and more committed than they have ever been. And the transfer of wealth that happened during the 5 months of pain was the largest in Bitcoin's history. Here is something I need to say to you directly, and I am going to say it even though it is uncomfortable to hear. The people who made the most money in Bitcoin's history were never the smartest people. They were not the people with the best price models or the most sophisticated algorithms. They were the people who could tolerate being wrong in public for the longest period of time. Think about what that means in context. During the 5 months of losses, the social environment was telling you one thing: get out. Your financial advisor was skeptical. Your family was saying they told you so. Every mainstream media article framed Bitcoin as a speculative bubble in collapse. Every comment section was filled with people celebrating the crash. The social pressure to sell, to conform to the bearish narrative, was enormous. It was designed to be enormous. Because in financial markets, the transfer of assets from weak hands to strong hands requires the weak hands to believe, with absolute conviction, that they are making the rational decision when they sell. The institutions make money because they have the capital to survive the psychological war. Retail investors lose because they do not. And the lesson is not that you should have held. Hindsight is easy. The lesson is that the next time Bitcoin falls 48% and the fear and greed index hits 5 and every social signal is telling you to sell, you now have a documented record of what the institutions were doing at that exact moment. You have the data. Use it. Before I go any further, and this is important, nothing in this video is financial advice. I need to be clear about that. I am not a licensed financial advisor. Bitcoin crossing $71,000 today does not guarantee it does not give back this move tomorrow. Analysts published notes today warning that this could be a bear market relief rally. A short, squeeze-driven spike that fails to hold. That is a legitimate concern. A real bottom requires sustained spot buying over days and weeks, not a single 6% candle. Bitcoin is one of the most volatile assets on Earth. Leverage can wipe out your entire position in minutes. Never invest more than you can afford to lose. If you are using borrowed money to trade Bitcoin, please be careful. The scenarios I am about to describe include a bearish outcome, and that outcome can happen fast. Please do your own research. Please consult a licensed financial professional before making major financial decisions. With that said, let me give you the real picture of what comes next. The most important level on Bitcoin's chart right now is not 71,000. It is not 74,000. The most important level for the next 48 hours is 70,000. Here is why. Bitcoin broke above 70,000 this morning. That is the easy part to see. But what happens when Bitcoin pulls back to test that level? And it will pull back. Every breakout gets tested. That pullback and how it resolves is the single most important signal for the next 2 to 4 weeks. If Bitcoin pulls back towards 70,000 and finds buyers, if the candle wicks down to that level and bounces, if the daily close holds above 70,000, then resistance has flipped to support. The breakdown level becomes the new floor. And that is the foundation for a sustained move higher. If Bitcoin slices through 70,000 on the pullback and does not stop there, if it keeps going to 68, 67,000, then today's move was a false breakout. The short squeeze exhausted itself and the bears are back in control. This is the binary. Watch the 70,000 level on the first significant pullback. That is your confirmation signal or your warning signal. Everything else is noise. Now let me give you the 3 scenarios for the next 2 to 4 weeks, and I want you to have all 3 of these in your head because the market does not care about which one you prefer. The bull case first. Bitcoin holds above 70,000 on the retest. ETF flow data this evening and tomorrow confirms that today's inflows are the beginning of a sustained reversal. Multiple ETFs positive, not just BlackRock. Bitcoin then grinds higher towards 74,000 over the next 5 to 7 days. And here is why 74,000 is so critical. In March 2024, 74,000 was where the previous bull run stalled for months. Then in April 2025, it held as support during the correction before the run to 130,000. 2 years of institutional memory at that level. Getting above it, and more importantly, weekly closing above it, is the technical confirmation that the correction is over and the next phase of the bull market is underway. In this scenario, the FOMC meeting on March 17th and 18th delivers a dovish signal, or at least no hawkish surprise. The Morgan Stanley ETF application moves quickly through the SEC review process, and the war de-escalation narrative, which prediction markets currently price at a 39% probability of ceasefire before April, begins to gain momentum. All three of those catalysts resolving positively in the same 2-week window would be the most bullish possible environment for Bitcoin, and if all three align, macroeconomist Henrik Zeberg's primary scenario of 110 to 120,000 becomes not just a target, but a reasonable base case for the second half of 2026. The second scenario is consolidation. This is actually the scenario I find most structurally healthy, not because it is exciting, but because of what it produces. In this scenario, Bitcoin does not hold cleanly above 70,000 on the first test. It pulls back to 68, maybe 67,000, shakes out the people who bought the breakout with leverage, then recovers, and instead of a clean run to 74,000, Bitcoin spends 1 to 3 weeks building a base between 68 and 72,000, trading sideways, absorbing the overhead supply, building the floor. Think of it like a building. You can put up walls quickly, but if the foundation is not solid, the building collapses. A 2-week consolidation above the previously rejected 70,000 level, while the Morgan Stanley ETF generates daily media coverage, while ETF flows normalize, while the FOMC meeting approaches, builds the strongest possible foundation for what comes after. In this scenario, every day Bitcoin spends above 70,000 makes that level stronger. Every ETF inflow day builds the institutional bid. And when Bitcoin eventually breaks through 74,000 from this base, weeks from now, it does so with the kind of momentum that does not get rejected. This is the Glacier scenario, slow, grinding, massive, and ultimately the most profitable for anyone with patience. The third scenario, the bear case. And I need you to hear this even though it is not what you want to hear right now. In this scenario, today's 6% move is a classic bear market relief rally. The short squeeze runs out of fuel. The $433 million in forced buying exhausts itself. The deferred ETF spot purchases get absorbed by profit takers who have been underwater for 5 months and are happy to sell near break even. Bitcoin falls back below 70,000 on volume with conviction, then 68,000 fails, then 65,000, where CoinGlass data shows $323 million in downside liquidation leverage stacked up, becomes the next major test. A break below 65,000 with volume triggers that liquidation cascade. And now you are looking at 63,000 again, the war crash low, and below 63,000, the next structural support is in the 60,000 area. This scenario activates if tonight's ETF flow data shows profit-taking offsetting the BlackRock inflow, or if the geopolitical situation dramatically worsens, specifically if oil supply routes get disrupted and inflation expectations spike, making the Fed's hands tied and rate cuts impossible despite economic slowing. I'm not saying this is the most likely scenario. I'm saying it is a real possibility. And if you do not have a plan for it before it happens, you will make emotional decisions in the middle of it. Know where your line is, know what would change your view, have the plan ready. 5 numbers you need to watch over the next 72 hours. Write these down. First, tonight's ETF flow report from Soso Value and Farside Investors. This is the single most important data point after today's breakout. A broadly positive day across multiple ETFs confirms institutional demand is real and sustained. A net negative day, despite today's price surge, is a major red flag. Second, the daily close tonight above or below 70,000. A close above confirms, a close below is a warning. Third, any statement or communication from the SEC about the Morgan Stanley Bitcoin Trust application, any acknowledgement, any timeline signal, any comment letter would be a market-moving catalyst. Fourth, Bitcoin dominance, currently at 59.61%. If dominance holds or rises as altcoins lag, Bitcoin's strength is structural. If dominance drops hard, it suggests speculative rotation rather than real institutional accumulation. Fifth, the US-Iran situation and oil prices. Prediction markets give a 39% probability of ceasefire before April. Any diplomatic development, any signal from either side, removes the primary macro headwind that has been crushing risk assets since the conflict began. Let me close with the thing that the 5 months of pain actually taught us, if we were paying attention. During that entire period, while retail investors were losing sleep, while the news was catastrophic, while the fear and greed index hit the lowest number in its history, the institutions were not watching from the sidelines. They were not waiting for confirmation. They were not waiting for a cleaner entry. They were buying, systematically, at scale, week after week, $635 million on the worst day, $322 million today when the breakout happened, $55 billion cumulative through every bear move since January 2024. And now Morgan Stanley, with the oldest bank in America as their custodian partner, with $1,600 billion in client assets behind them, filed the paperwork with the SEC to bring all of that capital directly into Bitcoin. The question is not whether institutional adoption is happening. It is documented. It is SEC filed. It is in the public record. The question is whether you understand the timeline it operates on and whether you have the patience to stay positioned for it. The institutions are not trading Bitcoin like a slot machine. They are building infrastructure, building custody relationships, building regulatory frameworks, building the plumbing for a multi-decade asset allocation shift. And every single day that infrastructure gets more complete, a Morgan Stanley filing here, a BNY Mellon custody agreement there, a Kraken Federal Reserve master account this morning, the probability that Bitcoin is a temporary phenomenon gets smaller, and the probability that it is a permanent fixture in global finance gets larger. You came into this video knowing Bitcoin crossed $71,000. You are leaving it understanding the full story, the 5 months of institutional accumulation that retail investors missed completely, the Morgan Stanley filing and what BNY Mellon, the bank founded in 1784, specifically signals about where Bitcoin stands in the global financial system, the $433 million short squeeze that powered today's move, the deferred ETF buying mechanism that explains why price was suppressed despite massive inflows all week, the 3 scenarios that define what comes next, and the $70,000 level that will confirm or deny whether today was the beginning of something real. That is not just data. That is a framework. And frameworks are the difference between reacting to Bitcoin and understanding it. Drop a comment right now. I want one answer. Now that Morgan Stanley and BNY Mellon are in, now that the bank that has existed since before the United States Constitution holds Bitcoin in custody, does the most skeptical person in your life finally take this seriously? Your parent? Your advisor? Your friend who called it a scam for 4 straight years? Drop it below. I read every single one. And if this video gave you the full picture that nobody else is giving you today, subscribe. Because on the days that actually matter in Bitcoin, this is where I will be. See you in the next one.